In September 2022, the most boring corner of global finance, British pension funds, came within days of a full-scale meltdown. On Friday, the 23rd of September, the UK government announced a package of unfunded tax cuts. By the following Monday, 30-year gilt yields had jumped around 80 basis points, a move of a size that long-dated government bond markets are simply not built to absorb in 2 trading days. Within a week, the Bank of England was in the market with an emergency program of up to £65 billion, not to fight inflation, not to support growth, but to stop pension funds from liquidating the country's bond market in a self-feeding spiral. This is the story of how the safest money in finance became the forced seller, and the machine that made it happen. Why should you care about British pensions? Because the LDI episode is the cleanest modern example of a pattern that repeats across every market. A strategy designed to reduce risk becomes, at scale, the source of systemic risk. The same mechanics, leverage, collateral calls, forced selling into a falling market, drove the 2008 crisis, the March 2020 Treasury meltdown, and the blow-ups this channel has covered before. If you understand this one episode deeply, you own a template for recognizing the next one before it has a name. First, the setup. A defined benefit pension has made promises decades into the future. Accountants value those promises by discounting them at long-term interest rates. So when yields fall, the liabilities balloon, and when yields rise, they shrink. Liability-driven investment was the fix. Use swaps and repo borrowing against gilts to make the asset side move in lockstep with the liability side. The funding ratio stabilizes. Elegant. But hedging with borrowed money means posting collateral, mark-to-market daily. Through September 2022, the leverage of these LDI funds, assets over equity, climbed from below 2 to around 2.7 as yields rose and asset values fell. The hedge was doing its accounting job perfectly. It was the cash mechanics underneath that were loading the spring. Now the quant wedge, the doom loop. When gilt yields spiked after the September 23rd announcement, every leveraged LDI fund received margin calls on its swaps and repo. Demands for cash today. A pension fund's assets are mostly not cash, they are gilts. So to raise cash, the funds sold gilts. But every LDI fund held the same long-dated gilts, and they were all selling at once into a market with no natural buyer of that size. Selling pushed yields higher. Higher yields triggered larger margin calls. Larger calls force more selling. Note the shape of this. The cash demand is convex. A one-day yield move twice as large does not require twice the collateral. Leverage means it can consume the fund's entire liquidity buffer and then some, because the buffer itself is shrinking as asset values fall. On paper, rising yields were making pensions better funded. In cash terms, the same move was bankrupting their hedge vehicles in real time. That is the wedge. A hedge that wins on the balance sheet can still kill you through the cash account, and when everyone shares the hedge, the exit door is one person wide. By Wednesday, the 28th of September, 4 days into a move of over 100 basis points on long gilts, the Bank of England stepped in. It announced it would buy up to £5 billion of long-dated gilts a day for 13 business days, a backstop of up to £65 billion. The effect was immediate. 30-year yields fell more than 100 basis points on the first day. And here is the detail professionals savor. Of the $65 billion on the table, the bank ultimately bought only about $19.3 billion, $12.1 billion of conventional gilts and $7.2 billion of index-linked. It never needed the rest. The panic was not about fundamentals. It was a coordination failure among forced sellers. The moment a buyer of unlimited size stood in the doorway, the doom loop lost its fuel and the fire went out. The size of the announcement did the work, not the size of the purchases. So here is the template Blowup leaves you. Ask 3 questions of any strategy at scale. Does it use leverage that demands cash when prices move against it? Is the same position crowded across many holders? And who is the buyer when they all need the same exit on the same day? When the answers are yes, yes, and nobody, the strategy is stable right up until it is the crisis. Pension funds were not reckless. They were prudently hedged, all in the same direction. Markets do not reward or punish virtue. They price cash, collateral, and crowding. Watch those 3, and blow-ups stop looking like lightning from a clear sky. Educational content, not financial advice.